The hidden credit score rule banks don't want you to know you're checking your credit score and it's sitting at like 720, maybe 740. Not perfect, but pretty good, right? You've been paying your bills on time, keeping your credit card balances low, doing all the things you're supposed to do, and then you apply for a mortgage or a car loan or a premium credit card and you get rejected. Or approved, but at a higher interest rate than you expected based on your score. And you're confused because you thought 720 was good. You thought you checked all the boxes. You did what the credit monitoring apps told you to do. But somehow, when you actually need to use your credit for something important, the score that looked great on your app doesn't seem to matter as much as you thought it would. My name is Jack, and I spend way too much time studying credit scoring systems, analyzing the gap between what consumer credit scores show versus what lenders actually use, and trying to understand why so many people are blindsided when their good credit score doesn't translate into the credit approval or interest rates they expected. And what I've discovered is that there's a fundamental disconnect between the credit score you see and monitor versus the credit score that actually determines whether you get approved and what rate you pay. And most people have no idea this disconnect exists. Because here's the hidden truth. The credit score you check on Credit Karma or your bank's app or most consumer monitoring services is not the score that lenders use to make decisions. It's not even close in many cases. You might be monitoring a Vantage score while lenders are using FICO scores. Or you're looking at a generic FICO score while mortgage lenders are using a completely different version. And the gap between these scores can be 20, 30, sometimes 50 plus points, which is the difference between approval and rejection, between 5% interest and 7% interest, between saving thousands of dollars and paying thousands more. So if you've ever been confused about why your credit score didn't get you the approval you expected, or if you're planning to apply for any major credit in the near future, or if you just want to understand how the credit system actually works versus how it's marketed to consumers, this is for you. Because understanding the hidden rules of credit scoring might save you tens of thousands of dollars over your lifetime. The score you see isn't the score they use. Let's start with the fundamental truth that most people don't know. There are dozens of different credit scores, and the ones you see for free are usually not the ones lenders use for important decisions. When you check your score on Credit Karma, you're typically seeing Vantage Score 3.0, which is a credit scoring model created by the three credit bureaus. It ranges from 300 to 850, and it gives you a number that looks official and meaningful. But here's the problem. Most lenders don't use Vantage Score. They use FICO scores, which are calculated differently and can vary significantly from your Vantage score. And even within FICO, there are multiple versions. There's FICO 8, which is commonly used for credit card decisions. FICO 9, which is newer but less widely adopted. And then there are industry-specific FICO scores. FICO Auto Score for car loans, FICO Bank Card Score for credit cards, and FICO Score 2, 4, and 5 for mortgages, which are older versions that lenders still use because they're mandated by Fannie Mae and Freddie Mac. So you might check Credit Karma and see 740. But your FICO 8 score might be 715. Your FICO Auto score might be 730. Your mortgage FICO scores might be 690, 705, and 700 across the three bureaus, and lenders typically use the middle score, so 700. You thought you had a 740, but the lender sees 700. And suddenly you don't qualify for the best rates. This is the hidden rule. The score you're monitoring for free is usually not the score being used to make decisions about your credit applications. And the difference isn't trivial. It can cost you thousands of dollars in higher interest rates or result in outright denial. I learned this the hard way when I applied for a mortgage. My Credit Karma score was 758. I felt great about it. Then the mortgage lender pulled my credit, and my scores were 712, 728, and 715 across the three bureaus. The lender used the middle score, 715, and I got a higher interest rate than I would have qualified for at 740 plus. That 43-point gap between what I thought I had and what the lender used cost me about $30 more per month, which compounds to over $10,000 over the life of the loan. The principle? Stop relying on free consumer scores to judge your creditworthiness. If you're planning any major credit application, pay for your actual FICO scores from myfico.com or get them free from certain credit cards that offer them. Know what lenders will actually see, not what Credit Karma says. The utilization timing trick that changes everything. Here's something that dramatically affects your score, but that most people don't understand. Credit utilization, the percentage of your available credit you're using, is calculated based on when your credit card company reports your balance to the bureaus, not based on whether you pay in full every month. Most credit cards report your balance to the bureaus on your statement closing date. If your statement closes on the 15th of the month, whatever balance you have on the 15th is what gets reported, even if you pay it in full by the due date a few weeks later. This means you can be a responsible credit card user who pays in full every month and never pays interest. But if you're carrying high balances when your statement closes, your credit score is being damaged by high utilization. Here's an example. You have a credit card with a $5,000 limit. Throughout the month, you charge about $4,000 in expenses. Your statement closes on the 15th with a $4,000 balance. That's 80% utilization, which is terrible for your score. Then you pay the $4,000 in full by the due date, so you never pay interest. But the damage is already done. The 80% utilization was reported to the bureaus and is hurting your score. The hidden rule that banks don't advertise: if you want to optimize your credit score, pay down your balance before the statement closing date, not just before the due date. Keep your reported utilization under 10% if possible, definitely under 30%. So, using the same example, instead of letting the $4,000 balance report on the 15th, you make a payment of $3,500 on the 14th. Now, when the statement closes on the 15th, only $500 is reported. 10% utilization instead of 80%. Then you pay the remaining $500 by the due date. You still paid in full, still paid no interest, but your credit score is dramatically better because the reported utilization was low. This timing trick can easily add 20 to 40 points to your score if you've been carrying high balances until the due date. I implemented this strategy and watched my score increase by 32 points in 1 month, just by paying my cards down before the statement date instead of before the due date. The principle? Utilization is calculated based on reporting date, not payment date. To maximize your score, pay down balances before your statement closes, keeping reported utilization as low as possible. The hard inquiry strategy. Lenders don't mention. Here's another hidden rule. When you're rate shopping for certain types of loans, mortgages, auto loans, student loans, multiple credit inquiries within a short window are treated as a single inquiry. But most people don't know this, so they're afraid to shop around, which costs them thousands in potentially better rates. The way it works, credit scoring models recognize that consumers should be able to shop for the best rate without being penalized. So, if you're applying for a mortgage and you get quotes from 3, 4, 5 different lenders within a 14 to 45-day window, the window varies by scoring model, all those hard inquiries count as just one inquiry for scoring purposes. This is huge because it means you can and should get multiple quotes when financing a car or a house without tanking your credit score. But most people either don't know this rule or don't trust it, so they only apply to one lender, accept whatever rate they're offered, and potentially overpay by thousands of dollars. Here's what this doesn't apply to: credit cards. Multiple credit card applications in a short time will count as multiple inquiries and can significantly damage your score. The rate shopping exception is specifically for mortgages, auto loans, and student loans. And here's the strategy that really optimizes this. Do all your rate shopping in a concentrated period. If you're buying a house, get all your mortgage quotes within 2 weeks. Don't drag it out over 2 months with applications scattered throughout. That defeats the purpose of the rule. I use this when buying a car. I got quotes from 5 different lenders in 1 week. All 5 pulled my credit. But because it was within the scoring window and was for the same type of credit, auto loan, my score only took the hit from 1 inquiry instead of 5. I ended up saving 0.8% on my interest rate by shopping around, which was about $1,200 over the life of the loan, and my credit score recovered within months. The principle? Understand the rate shopping windows for different types of credit. Use them strategically to get the best rates without multiple score hits, but never do this with credit cards. Those should be spaced out by months if you're applying for multiple cards. The credit mix myth that keeps people in debt. Here's a rule that's technically true, but that banks love because it keeps people in unnecessary debt. Having a mix of credit types, revolving credit like credit cards, installment loans like car loans or personal loans, mortgage debt, can positively affect your credit score. Credit mix accounts for about 10% of your FICO score calculation, and lenders and credit monitoring services will often tell you that you'd benefit from having more diverse types of credit. If you only have credit cards, they might suggest getting an installment loan to improve your mix. But here's the hidden reality. The credit score benefit from having diverse credit types is minimal, and it's almost never worth going into debt just to improve your credit mix. Taking out a car loan you don't need or a personal loan just to have an installment account is a terrible financial decision that might boost your score by 5 to 10 points at most. The banks benefit from this myth because it encourages people to take out loans they don't need, which generates interest income. Your credit monitoring service benefits because it can recommend products and collect affiliate commissions. You don't benefit. You've gone into debt for a marginal score improvement that probably won't affect your approval odds or rates in any meaningful way. The exception is mortgage debt, which is generally considered good debt if it's affordable and helps you build equity. But even then, you shouldn't take out a mortgage just to improve your credit mix. You should take it out because homeownership makes financial sense for your situation. I've never taken out debt solely to improve credit mix, and I have an excellent credit score. I have credit cards and a mortgage. That's my mix. I've never had a car loan, paid cash for used cars, and my score has never suffered for it. The credit mix component is so small that it's not worth optimizing if the optimization means unnecessary debt. The principle, don't go into debt to improve credit mix. The score benefit is minimal and the cost and interest is real. Focus on the factors that actually matter: payment history and utilization. The authorized user hack. They don't advertise. Here's a legitimate strategy that can quickly boost credit scores, especially for people with thin credit files or those rebuilding credit. Becoming an authorized user on someone else's old, well-managed credit card. When you're added as an authorized user on a credit card, that card's entire history often gets added to your credit report, including the age of the account and the payment history. If you're added to a card that's been open for 10 years with perfect payment history, your credit report suddenly shows you've had a 10-year relationship with that creditor, even though you just got added yesterday. This can dramatically improve your credit score, especially if you're young with limited credit history or rebuilding after past issues. The average age of accounts is a significant factor in credit scoring, and authorized user status lets you borrow someone else's account age. But here are the rules for this to work effectively. The primary cardholder must have excellent payment history on that card. The card should be old, the older the better. The card should have low utilization. Not all credit card companies report authorized users to all bureaus. Verify before adding. And here's the catch. Some lenders are getting wise to this strategy and may discount authorized user accounts when making decisions, especially if they can tell you're an authorized user who doesn't actually use the card. But it still helps with your credit score, which can be useful for various purposes. I had a friend with thin credit history at age 24. Her parents added her as an authorized user on a card they'd had for 15 years with perfect history. Within 2 billing cycles, her credit score jumped from 680 to 741 because her average account age went from 2 years to 8 years. She then qualified for credit cards and rates she couldn't access before. The principle: authorized user status can be a powerful tool for building credit quickly, especially for young people or those rebuilding. But it works best when it's a legitimate family arrangement, not a paid service from strangers. The closed account aging myth. Here's something that confuses a lot of people. They think that closing a credit card will immediately hurt their score by reducing their available credit and increasing utilization. While that's true, there's another factor most people don't understand about closed accounts. Closed accounts in good standing continue to age and contribute to your average age of accounts for up to 10 years after closing. They don't immediately disappear from your credit report the moment you close them. This means the impact of closing a card on the age of accounts factor is delayed, sometimes for a full decade. What does immediately impact your score when you close a card is utilization. If you had $10,000 in total available credit and you were using $2,000, 20% utilization, and then you close a card with a $5,000 limit, You now have $5,000 available, and you're still using $2,000, 40% utilization. Your utilization ratio just doubled, and your score will drop. But the age factor? That won't hit you until that closed account finally falls off your report years later. So people often close cards thinking they've destroyed their credit through losing account age, when the actual damage is coming from the utilization change. The hidden rule here: don't close old credit cards in good standing unless you have a compelling reason, annual fee you can't justify, for example. Keep them open with occasional small purchases to keep them active. Each old card is helping your average account age and providing available credit that keeps utilization low. But if you do need to close a card, understand that the age impact is delayed while the utilization impact is immediate. Plan accordingly. Pay down other balances before closing a card so your overall utilization doesn't spike. I closed a credit card with a $12,000 limit a few years ago because of an annual fee I didn't want to pay. My score dropped 18 points immediately because my utilization on remaining cards jumped from 8% to 15%. But the average age of accounts didn't change at all. That closed account is still aging on my report and will for years. The principal: closed accounts continue aging on your report for up to 10 years. The immediate impact from closing a card comes from utilization changes, not age changes. Factor this into decisions about closing accounts. The credit freeze protection secret. Here's a strategy that more people should know about, but that credit bureaus don't exactly advertise. You can freeze your credit for free, and doing so doesn't affect your score, but dramatically reduces your identity theft risk. A credit freeze prevents anyone, including you, from opening new credit in your name unless you temporarily lift the freeze. This means identity thieves can't open credit cards, take out loans, or do anything else that requires a credit check in your name, even if they have your social security number and other personal info. And here's the key: freezing your credit doesn't hurt your score, doesn't affect existing credit accounts, and doesn't prevent you from using current credit cards or making payments. It only stops new account applications. You can freeze your credit at all three bureaus, Equifax, Experian, TransUnion, for free online in about 15 minutes total. When you need to apply for credit, you temporarily lift the freeze at whichever bureau the lender will check. Complete your application, then refreeze. It's slightly inconvenient, but it's excellent protection against identity theft. Most people don't do this because they don't know it's free and easy, or they think it will hurt their credit, or they're worried about the inconvenience. But in an era where data breaches happen constantly, and your personal information is probably already compromised somewhere, a credit freeze is one of the most effective protective measures available. I've had my credit frozen at all three bureaus for years. When I need to apply for credit, I lift the freeze at the relevant bureau for 24 hours, complete the application, and refreeze. It adds maybe 10 minutes to the process, but gives me enormous peace of mind that nobody can open credit in my name. The principle: credit freezes are free, don't hurt your score, and provide excellent identity theft protection. The minor inconvenience when you need to apply for credit is worth the security benefit. The income to credit limit trap. Here's something most people don't realize affects their credit decisions. Lenders look at the ratio between your income and your total credit limits. And if your limits are too high relative to your income, you might get denied for new credit, even with a great credit score. This is because lenders worry about the theoretical scenario where you max out all your credit at once. If you make $75,000 annually and you have $80,000 in total credit limits across all your cards, a lender might decide you're overextended even if you have perfect payment history and 2% utilization. This isn't part of the credit score calculation, but it's an underwriting criterion that lenders use behind the scenes. And it can result in you being denied for new credit despite having an excellent score, leaving you confused about why you were rejected. The hidden rule: having too much available credit relative to your income can work against you when applying for new credit, even though keeping utilization low, which is easier with higher limits, helps your credit score. It's a weird contradiction in the system. The solution isn't to close accounts to reduce your limits. That would hurt your utilization ratio and score. The solution is to be strategic about credit limit increases. You don't need to accept every increase offered, especially if it's pushing your total limits to 2 times or 3 times your annual income. Please like and subscribe to support us.